think, act, and prosper. You are now tuned into the Money Level Show.
Hey, Danny, glad to have you back on the show.
Yo, Daryl, thanks for having me back.
Yes. I've been in the background stalking the Capital Cosm. Just like, oh my God, Danny, he got Peter Schiff. He got this gold bug here on the channel. So it's been cool just seeing the success and everything.
Hey, man, thanks for being a loyal Capital Cosmonaut. I really appreciate it. I've been watching the Money Level Show, continuing to level up. Super excited to see where you guys go from here.
For those that don't know, sometimes YouTubers like we stalk each other's channels. Like we just like, what's this guy doing over here? What is this guy
Yeah,
doing over here?
it's all open source data for the most part. I mean, you're not going to know like the nitty gritty, but it's always you've got to have a benchmark of some sort.
Yeah, for sure. So we got a lot of energy and excitement around precious metals, gold and silver. And so I want to get your take on just where do you think this market is heading? Because I mean we have a lot of people that are saying like China's buying a lot of gold and silver, the citizens there are buying a lot. And then we also have the supply demand issues. We have the debt issues. There's so many like tailwinds for gold and silver. It just seems like overwhelming at times when you think like, oh, I forgot this is a tailwind too. So I want to get your assessment on gold and silver right now.
Yeah, so the assessment behind gold and silver, as you kind of alluded to there, buying has been mostly predicated by China and central banks across the globe. When you do like searches across Google Trends, there's really not much traction for terms like gold stocks to buy, where to buy gold, things of that nature. So retail isn't really what's pushing this price up. And also, I mean, gold is a $15 trillion market cap asset. So, these moves from, let's say, 2000 to 2400. I mean, that's a pretty significant move. That's what, a 20% move up in the price. So, I mean, you're talking trillions of dollars sloshing around in the gold market to move that price up. So it's not solely retail that's pushing this, or obviously it's not retail, but it seems to be driven by these central banks. Now, you've got a number of different things going on in the backdrop. You're starting to see copper rally. Your copper to gold ratio is going up, which is an indication that you're probably going to see more inflation down the line, and which precipitates a rise in the gold price. You're also starting to see the gold to silver ratio come down, meaning that silver has begun to outperform gold. Now, why that's important? It simply means that we're finally at a stage where silver is catching a bid. Silver's been in this $20 doldrum for about 4 years now. And it's the same ethos, the same kind of rationale as to why you want to see mining stocks rally to further precipitate that bull market, because it tells you that money is more willing to go down the speculative daisy chain, go down the risk curve. Obviously, silver is more risky than gold. Silver has a much smaller market cap. It's more volatile than gold. So to see silver begin to outperform gold, that's another telltale sign. And you look at a 10-year treasury chart, we've broken through from this descending channel that we've been in for about 35 years, since the 1980s. And rising interest rates, as counterintuitive as it may sound, is a further testament of a rising gold price. So I think we still have a lot of room to grow. Retail still hasn't gotten into this thing. And listen, you're entering a sovereign debt crisis across the globe. Now, the United States is still the cleanest shirt and dirty hamper. It's the whole milkshake theory. But there's going to come a point where you go to places like Turkey, you go to places like Argentina, Lebanon, all these places that have been affected by hyperinflation, they're not asking for gold at this very moment. They're asking for US dollars. Now, when the party ends from the USD side and all those euro dollars have to come flooding back in, gold is naturally going to replace dollar demand or silver or some combination of such. Typically silver is the common man's gold. So you might make a case for silver. So I think, we are at a very interesting time. This is probably a once in a lifetime ordeal. I don't think you're probably going to experience anything as bullish as this probably in your lifetime again, because we are at the very early stages of a monetary reset across the globe. And what happens during these monetary resets is that it also filters down to the commodity complex. So there hasn't been a monetary reset in some form that didn't affect commodity prices down the daisy chain. That includes oil, copper, uranium, you name it. Okay. So I think, you and I, our channels, our audience, we're in the right space. It might seem lonely at times. It might also seem like, oh, we've hit a high because this person talked about gold in such a bullish fashion. Listen, guys, normies are not watching this stuff.
Mm-hmm.
This is just, we're kind of isolated in and of ourselves. And we're still at very early stages of this bull market. You can typically classify a bull market into 3 different stages. You have your accumulation phase, which is where your super contrarians come in that buy up distressed asset when no one else does, when no one else wants to. Then you have a second stage where institutional money starts to come in. You start to see a bid on these commodities, on these assets, and then finally you have a blow off top when retail comes in. So it's a super contrarian phase, a smart money institutional investor phase, and a retail blow off top. Those are your 3 stages that I see. And I think we're still at that very first stage at this very moment. I mean, yes, institutions have begun buying up things like uranium to a degree. We've seen a number of big time hedge fund guys, buy up Barrick Gold. I think who was it? Warren Buffett had like a 0.5% holding in Barrick Gold, but it's still minuscule. You look at institutional holdings of gold and gold mining stocks or commodity stocks. I mean, it's like sub 1% compared to what it was in the 1980s of total global assets, which was 20 to 30%. I mean, so I'm not saying that we make a return back to 20 to 30%. That's a 20 bagger right there, assuming everything else holds constant. But even a move from 1 to 2% is a doubling. And if you own the equities are, in theory, supposed to be leveraged itself. So you could see, from a 1 to a 2x, that could be something more explosive. That could be a 3x, a 4x. I don't know. It's case by case, but you kind of get the picture there. So I know I was all over the place there, but I just wanted to paint a complete picture of gold and how it kind of plays into this commodity super cycle narrative.
Yeah, so I do want to, a few things. I want to get into some charts. Right now, I am, um, wanting to look at the dollar. So I'm going to go ahead and share screen. Look at the dollar index, and obviously, we're kind of in this weird. It's like, I wouldn't say weird. I guess it's kind of weird, but it's a different time where gold has rallied along with the dollar at times. Even when you look at from this year, the dollar, went from January of 24, it rose from 100 to about 106. Gold was rallying during that time. And, ultimately, because some people would say, well, the gold buying is what's driving the dollar down, like, because the dollar's being repriced against gold or whatnot. And so like I don't even know if I framed that right, but I'm trying to see like, okay, what point are we going to see the dollar start to really crater, and gold and silver go a lot higher? I mean, because you look at, I mean, over since the global financial crisis, I mean, the dollar is up significantly. I mean, I can't even see down there. I'm trying to see where was it at, in 2014, the dollar was at 79. And so we haven't seen this cratering of the dollar just yet. And so I'm wondering what event is going to oh, look at that. Early 2000, the dollar was significant. That was the dot-com bubble. So, I just want to see like what do you think is in the cards for the dollar to fall sharply against gold?
Well, I think gold still hasn't taken its seat as the safe haven asset. I think the dollar is still that safe haven trade. I can show you a couple charts
Yeah,
to kind of illustrate what I'm talking about. And basically, the U.S. is still looked at as kind of the shining hill, shining city or village on the hill. And we're pretty much being propped up by foreign capital because there's nowhere else. There's really we're kind of the best bet out there. And let me pull this up for you really quick.
Yeah, go ahead.
So this is
Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
okay. So let me know if you can see this. So basically, foreign investments in U.S. markets finally eclipsed $25 trillion. So we're still, I mean, we're not at the 2021 highs, but this is data as of 2023.
Mm-hmm.
There's a lot more money in 2024 today at the time than there was in 2023. So I think what's happening is capital is flowing from Europe, it's flowing from South America, it's flowing from across the globe into the United States, because the United States is still that safe haven, which is what gold will eventually take back its mantle of, but it hasn't fully come into that stage yet.
Yeah. So, I mean, I imagine so one thing about this chart here that the audience should know, this is stocks. So we're not talking about bond buying or anything like that. If anything, banks and people have been selling treasuries. But and then I've seen that there's been some issues with the bids and everything.
So here's another good chart to look at. So I'm going to pull up the world stock index. Let's just hide this. So this is the world stock, and it's basically an index of the entirety of the world stocks, right? Now, if you overlay that with, let's say, the S&P, the world stock index does appear to, at first glance, you can kind of make the assessment that it might be tracing the S&P, which is the U.S. equivalent there. But you got the S&P here in two, and despite making kind of similar patterns, the S&P has outperformed the world stock index by almost 3x, right? If you
Hmm.
would have invested in the S&P starting in '08 at the tail end of the crash there, you'd be up 312%. Compare that to the world stock index, which is only up 122%. So the American stock market is vastly outperforming the world, the rest of the world. And that's really in my view, that's really what's propping up dollar demand as well. Because you've got to buy USDs to buy US stocks as
Hmm.
well, because they're denominated in USDs.
Yeah, yeah, for sure. So, so what does this mean for? I mean, you like with gold, right? Gold's rallying already, right? And from your assessment, we're seeing that okay, well, a lot of investment is still going into U.S. stocks. We look at 2023 data. We just looked at the S&P chart, right? So a lot of foreign investment is going into U.S. stocks, and the dollar is staying propped up, right? And so gold is rallying in the midst of this, in which gold is usually the contrarian play. I don't know if it's sending off signals or something bigger is going to happen or what. What do you think is well, obviously we have central bank buying, like so it seems like these different forces that is pushing gold up, at the same time that U.S. stocks are going up. What are you thinking there?
I think gold is playing sort of the role as the prelude to the next leg up in the commodity super cycle. You basically saw this in 2020, and where you saw gold start to rally, make new all-time highs in 2020, and then the following year, you started seeing CPI prints start to tick up. You started seeing the Thomson Reuters Commodity Index start to tick up. For a lot of your listeners, they started seeing their commodity portfolios start to tick up. So gold was sort of like the leading indicator to all of this. And if history is any indicator here, I think it's telling us the same thing. Gold catches a bit first, and then capital moves down the commodity space. And it's really not about what you're long in, as long as you're long in gold. Oh, sorry, you're long in a basket of commodities. You're going to see some of that halo effect, let's call it, play its way down.
Yeah, yeah, for sure. Okay. And then I was just looking at the silver chart recently. So I had just like actually thought about this. Actually, could you pull up the silver chart?
Yeah,
I gotta, yeah, this
yeah.
freaking
1 second. Okay, silver.
my trading view just be acting up sometimes. Like it'll blow the chart out, and I'm like, how do I fix it?
Yeah, so this is silver, and we are at $32, 32.15 at the time of this recording. This is on the monthly candlestick. Let's pull up a daily. Well, let's look at the monthly really quick. Um, this is on a linear scale. If you look at it from a logarithmic scale, you can kind of see this pattern here, the squeezing wedge pattern. We broke a lot more significant than breaking through on a daily candlestick because it elucidates a stronger trend. It means that you're starting to see this occur on a longer term time horizon. And the distance between this peak here and this breakout here is 13 years. And the
Hmm.
longer we've been coiling up here, it's it's Newtonian mechanics in a sense. The longer you're going to coil up, the more energy you're going to have pent up for this bounce up. So super bullish silver here, as we kind of alluded to before. The gold and silver ratio is telling you kind of the same thing as well. We broke out of this 13-year consolidation period, and we'll see where things go. I mean, but it's looking really good with silver. Despite the fact that gold's at all-time high, silver is still, I want to say, what was it at the previous high? $50. So, you're still about 40% off your all-time highs.
Yeah,
So to kind of play catch up fully with gold,
yeah,
you've got to make at least a doubling. Is my kind of like rough estimate just from looking at this.
Yeah, I was looking at the chart recently, and when I saw it was above 30, and I looked at the last few years because I was thinking in 2020 it had hit 30, but it actually didn't. It was at about 28, 29.
Yeah,
And
barely missed it.
yeah, yeah, barely it never closed above 30. And then now we're actually closing above 30. I mean, we've closed above 32.
And- Yeah, and that's significant. I mean, we still have about a couple days left for the month of May, but come on, guys, it's not going to drop all the way back down to 28, $26 to where it's opened at. So I think silver's in really good shape. The fact that it's probably going to close somewhere in this area is all very telling. We haven't seen a candlestick this big for for silver on a monthly period since 2020, which was back in July, almost the same time 4 years ago, which is what you
Yes.
saw here.
Yeah, definitely. And there's I wonder about the um so when I'm looking at like silver equity. So when we saw the equities rise, and I mean around that time to 2020, if you look at like AG, like First Majestic,
Hmm.
um I was looking at their chart, and they're still pretty far down from where they were when silver was at a lower price. And so, I've been trying to make sense of like the equities, and some people are like, oh, well, you got to hold the physical, right? Or whatnot. But it's like, man, these equities were rallying not too long ago, and they went up significantly, especially during that silver squeeze time.
Yeah. So this is AG relative to the silver price. You have support here. You just bounced off of it. There's no telling whether or not you're going to come back down and retest it. But I did pull up an interesting view of things. This is as it relates to gold, right? So you can make the same argument with the gold miners that the gold miners haven't really kept up with the precious metal itself. So if you look at the gold miners, at the top here, you've got GDX, which is your mainstream gold mining index. And from a TA point of view, you have this long stretching resistance line. Again, starts in 2011, I wanted to say. And you so far, the month of May, looks like we're going to break out of this resistance line. So this is huge. This is 13 years in the making. But oftentimes, look, gold was at an all-time high. Gold is at an all-time high today. It's at a higher price today than it was back 13 years ago. But yet the GDX is still trading about 50% down from from where it was in 2011. So how do you reconcile that? So the answer to the question is the GDX is a non-discriminating ETF of the entire gold mining index, the gold mining sector, so to speak. And that's not where capital is flowing to. And so what I did, I went over here, I looked up the largest gold mining companies by market cap. So that includes things like Newmont, Agnico, Barrick, blah, 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 Wheaton, Precious Metals. And I essentially created my own ETF here, down here. So you could do this on TradingView. You can see here, I've got Newmont, I've got Barrick Gold, Wheaton Precious Metals, etc. And what you'll notice is that despite the fact that we're still up 16% below that, we are, however, above where we were in 2011. We're about 24% off the highs in 2011. So basically what this is telling you is that if you would have just invested in a basket of the largest gold mining stocks, you would have outperformed by, the GDX is down 50% versus gold. The GDX is down 50% versus its 2011 highs, whereas a basket of the largest gold mining companies is 24% above its 2011 highs. So that kind of paints a picture. I know you've all heard Rick Roll say the vast majority of gold mining stocks, precious metal stocks, are underperformers. The sector is really being carried by a handful of performers. And I think that's what's going on.
Hmm.
So it's really about the quality of stocks that you're looking at. You can't just pick a random assortment of gold stocks and expect it to outperform
Yeah,
much the same way that you would with some of the bigger cap stocks. And you saw this happen with CCJ, right? In the uranium space. A lot of people kind of moan and complain about the fact that the uranium mining sector hasn't really taken off compared to the metal. But if you own CCJ, it has. If you own Kazatomprom, it has. If you own NextGen, it has.
yeah,
But
that's
if you
true.
own like a 50 million market cap Explorer, then the answer is probably no, it hasn't taken off.
Yes, it seems like there's a lot more market forces that need to get behind that. So I had so even with like uranium, I was buying CCJ back at like $14, and I didn't hold it. I didn't hold it the whole way, y'all. Like, I'm not gonna sit here and act like I got in at the bottom, right? I mean, I did get at a low price, and we had that first retail come in and buy, and then I ended up selling. So what helps you in terms of like, I mean, sticking with gold and silver? How do you view it as a in general? So, right, some people view it as an investment, some people view it as insurance, some people view it as insurance for your wealth against a hedge against crisis. Some people may never sell their gold and silver coins, right? And so, how do you personally view it?
So the physical, I view it as simply insurance. It's something you're just gonna allocate a 5 to 10% weighting, some arbitrary weighting that works with you, and you're basically just gonna hold it until you want to give it to your kids, or you have to sell it for whatever reason you want to sell it for. For the gold mining stocks, listen, I mean, these are all speculative names. You're just swinging for the fences. Yeah, that's the way I look at it. And then you've got the paper ETFs. That's a way to play it. So if you're going to have to pay up some fees. This is really interesting. If you don't mind, we can look at things like let's pull up the price of gold relative to GLD, and you'll see how much gets eaten up by fees and so forth.
Let's see. Let's see this.
Yeah, so this is the gold. So you got the gold price relative to GLD. And you can see here that the gold price has been outperforming. If you stretch this out back to its maximum time frame, which starts all the way back in 2004, you can clearly see that over time you're going to lose uh, you're going to lose value in GLD relative to the gold price.
Hmm.
And a lot of it is just fees that's going to just eat you up. So yeah, I mean, you could buy the GLD and not have to worry about the hassle of where to store your gold, and if you want to bury it in your backyard or things of that nature. But you're gonna have to pay some sort of a premium for that. So from the lows here to the top here,
So could
it's an
you
11% rise.
could you explain just a little more what this chart is saying? So this is the GLD over the G. It says GC1, the gold
Yeah,
price.
so this is the gold price relative to GLD. So this is the gold price priced in GLD, and it's basically telling you that the gold price has been outperforming the GLD
Okay, yeah,
for over a decade now.
gotcha. And then if it reverses, then the GLD will be outperforming the gold price.
Yeah, yeah, but that's probably not going to be the case
Yeah,
because you pay an implicit fee when you hold these ETFs. So just
yeah.
an FYI. I mean, so
You're paying
just
like 1% or something like that.
yeah, but it obviously you can see here it compounds over time.
Hmm. Yeah,
So
yeah,
now, if you would have just invested, let's say you put 100 grand, you could buy 100 grand in gold bars or 100 grand in GLD back in '05. That 100 grand would be worth whatever it is today, but your GLD would be worth 10% less as
yes.
a result.
So and I mean it, but in the grand scheme, I feel like in the grand scheme of things, just looking at inflation, right? Like we haven't seen, even though gold is at an all-time high measured in dollars, like we have not seen it uh, adjusted for inflation, like at an all-time high adjusted for inflation.
Hmm.
So I mean, the price of gold, I mean, back in 2011, it hit what 1800. You know, in the 70s, it hit about 850, something like that. And you know, looking at where it is now, like inflation has outperformed gold in over those years. And so it's kind of interesting. You know, I'm hoping that, you know, we do see like um a price of gold that factors in inflation, you know, that outperforms inflation. But you know, who knows?
I think it's going to happen. I think that's why, despite the fact that we're at all-time highs in gold, there's very little excitement. Even you turn on CNBC, no one's talking about the price of gold hitting $2,400. When
Hmm.
you talk about adjusting for inflation, try adjusting for the M2 money supply. Inflation is, in my view, it's kind of nonsensical. Yeah, it's nonsensical in the sense that it's dependent upon human input, meaning that whatever the economists deem is a worthwhile substitution to an item, whatever they deem is a sort of hedonic adjustment to add into the index, you're kind of at the mercy of the statisticians at the in the government there. But if you look at gold price in the M2 money supply, which is as not a perfect measure, but it's in my view it's a lot better than pricing in CPI. Gold is still way below. It's still way below its highs. I can pull that up really quick as well. It's actually quite astonishing. And the M2 money supply, you know, your audience knows, I'm presuming, is the amount of it's the money that's sloshing around people's bank accounts, and money market funds, etc. It's money just sloshing around the economy. And when you control for that, so this is the gold price controlled for the M2 money supply. And this is where we're at now. So we're indexed. So the index is currently at 77. The peak here in the 1970s was 400. So you can do the math there. I'm not calling for a strict retracement back up to these highs, but even if you make a retracement back to the 2011 highs, that's a doubling there, right? Going from 77 to 140 just about. You know, just a small retracement of some sort is going to take you to astronomical heights. So I'm very bullish on gold at the moment. Yes, short sorry. Yes, short term, you definitely see a pullback. We have seen a pullback from 2450 back down to 2300. We're sitting at 2350 now. But that's just the way these things work. I mean, this took 13 years to play out,
Hmm.
right? This took 13 years to play out. So this is a big ship that's making a turn.
Yeah.
But if you view gold as an insurance hedge, then you're going to see a lot of these gains materialize. Now your quality of life might improve because everything else gets more expensive with gold, and gold is not an investment, but the price will definitely go up.
Hmm.
That's where the mining equities come in. Those are kind of your leverage place to outperform kind of inflation there. That's gold's job to do.
Yeah. Yeah, and even as you know, we wrap up. So people that I've noticed that investors, like I've had Jim Rogers, you've had Jim Rogers on your channel too. Uh, like he tells, he says that he's not buying gold at these prices, but Jim has been buying gold for a long time. I mean, probably since you've seen that huge dip in the gold over the M2 money supply back in the 2000s or whatever. When it was like 200 an ounce or whatever, right? So, I mean, if you're buying in at 200 an ounce, you're most likely not going to be buying at 2,400 an ounce, right? So, that's a hard pill to swallow. Are you currently are you still buying physical? Do you have any principles in place like, oh, I just trade, a certain number of dollars per month to buy, a physical ounce of gold or ounces of silver or whatnot. Are you still currently buying, or are you just sitting on the sidelines?
So not now. I'm not buying right now, just because I don't have any capital to deploy right now. But if I were to have to deploy any capital, I would. I think it would be. I think it's time to go after. I would probably swing for the fences and just go after some high quality mining stocks and
Hmm.
see if I can get some home runs with that. Because I mean, this is once in a lifetime. You've got to make hay while the sun's still up.
Dang. Go ahead. Sorry about that.
No, you're good. And the thing with Jim Rogers, like, and I get this a lot. I see this a lot with people on my channel and other channels, is that they'll see an expert come on and give his picks on what they're buying or selling, and they'll automatically try to mimic that. Well, I mean, you're kind of doing yourself a disservice, because if you're following someone on the buy side, okay, you might know what they're buying today, but you're not going to know when they're selling.
Mhm.
Trading is a two-way street, and they could have sold and you could still be waiting.
Yeah,
So
exactly.
to base your allocation strategy just simply on what expert you've heard on YouTube say that they're buying, it's not a it's not going to take you far. It might actually be a detriment to
Mhm.
you, especially if you don't understand the rationale as to why they're buying it.
Yeah, and you got to.
Because you have to follow something that's repeatable and replicable. So are they buying it because a certain stock is breaking out versus the commodity? Okay, fine. That's something that's repeatable. I can look at it. I can keep tabs on it. I can keep tabs of, if that's the rationale behind why I should buy a bear of gold, then fine. I can I can read into that over time. But if it's just, oh well, so and so said he was buying bear gold, what good does that do you? You don't know
Mhm.
why they're buying it. You don't know what their strategy is, what their allocation strategy. Everyone has a different allocation strategy. Everyone has a different portfolio strategy.
Yeah,
So, my opinion is, I don't just go off of stock picks from experts.
yeah, yeah,
Really try to understand it yourself.
yeah, yeah. Definitely. I mean, there's a couple things. I mean, because I've seen people come on my show, or not on my show, but in the comment section. Oh, this person made a bad call, and this, I lost a lot of money, or I blew this
And
amount of money following such picks, and it's just like, well, first of all, like we're interviewing multimillionaire billionaires who
and you
have.
know what? They don't bat 1,000.
Yeah,
Millionaires, billionaires, successful hedge funders, they can still swing out and miss and
yes,
strike out.
yes, for real.
But I mean, their play is that they make more than they lose. It's that it's that small edge that they have. And if you're gonna, would you take advice from someone if you knew they had a 52% accuracy rate or a 55% accuracy rate? I mean, that's really how a lot of these guys do it.
Yeah,
They're not hitting 100% of these pitches.
yeah, exactly, exactly. So, for me, one thing I'm speculating in right now, a little bit. I'm not throwing a lot of capital here. I've been buying these palladium 1 grammers. I was buying these at $100 a pop, probably about 2 years ago, 2.5 years ago. And these are now, I mean, obviously they got premium, but I'm able to get them at half, 50% off, 50 bucks. So, it's I just been kind of speculating there, in terms of I don't know much about the palladium. I know it goes into, you know, uh combustion engines to help reduce emissions and such. And I do think that, we're a long ways off from everyone having an electric vehicle or whatnot. There still has to be a lot of upgrades to grids and everything, right? Um, but that's kind of an area I've been speculating in. I have been buying some silver and gold at a if I'm able to get like a fair price. Like some of the people I work with, they're not hungry for premiums, or if I got people that owe me a favor and they're like, all right, I give this to you at a discount, I'll buy it. But I'm not actively buying from at with the premiums on it now. So that's where I'm at.
Yeah, I think with palladium, isn't it inversely correlated with the commodity index? So the better the commodity space does, the worse palladium does, and vice versa.
Yeah, probably so. Who knows? Who knows?
Just FYI.
It's a speculation for sure. I mean, same thing with platinum. I've been thinking about getting back into platinum too. But I know that when I've listened to like Jeffrey Christian, um, he's talked about, whenever there's a surplus, which he says that there's been a surplus in like platinum and such, like the price isn't gonna perform well. I mean, because we remember like I mean, you remember rhodium, right?
Mhm.
But rhodium was like crazy at like 17, what was it, 17,000 an ounce and such. That was just insane. I mean, palladium was at like 2,500, an ounce at some point. And so yeah, it's kind of I don't know fully know the cycles or whatnot. I'm just speculating because it's cheap.
Yeah, but everyone has their own strategy. I mean, that's the point I'm trying to put across. So don't just, people on YouTube, do your own research. Obviously, nothing we say is financial advice.
Yeah.
Really try and figure out this thing on your own. Try to understand ratios. Try to understand where we are in these cycles, what these cycles are, and just zoom out. Just understand history. And
Hmm.
then you won't have to, wait for the latest, XYZ interview from insert your favorite YouTuber here to
Yeah.
figure out whether or not you should still be long a certain asset or not.
Yeah. Agreed. Well, all right, Danny, appreciate you for coming on. Everybody, be sure to go check out Danny at Capital Cosm. I will link to his YouTube channel as well as his X profile or Twitter account on in the description below. So be sure to check him out. And thank you for coming back on.
Yeah, it was a blast, Daryl. Happy to do it anytime. And yeah, if you want to follow me on X at Capital Cosm and on YouTube at Capital Cosm. So
All right.
we'll do it soon again.